So thank you so much for joining us today in the webinar on how we can look to manage your finances as we deal with the coronavirus. So thank you again for taking the time to join us today. We'll be covering in the next about 45 minutes or so the following, which is a little bit of background about the pandemic and how it relates to other similar disruptions that we've experienced in the past. And then a little bit about how individuals like you and I are able to deal with the pandemic from a financial perspective. I'll transition then to talk to you a little bit about asset allocation and what that means and how it can be brought to bear in helping you come up with a good strategy for managing your money as you deal with this. And finally, what a company like PeakAlpha does, which is really to provide financial advice to help people cope with situations like we are going through today. So wanted to give you a quick status about where we stand. So we've done one of these webinars about, I would say, 5 or 6 weeks ago, and things have moved rather dramatically since then. India is now on the list of countries that are affected and affected in a fairly meaningful way. But there are certain interesting aspects to this. One, of course, worldwide, about 5 million people are confirmed as infected by the virus. And India is about 118,000 at this point. A few interesting things. One, of course, is that if you look at it as a cases per million, then compared to many of the numbers above us on this board, you can see that India is only at about 87. The pessimist would say, give us some time, and then we'll get higher up. But frankly, so far, I would say compared to many other countries, we've sort of gotten off to a reasonably good start in terms of how we've been able to deal with this. The interesting thing to see is that China's numbers are even less, but I guess the good news about looking at that is that China has been able to get this under control, put it behind them and move on. The same number, if you look at cases per million, when you look across the world, the other interesting thing that leaps out is the darker blue ends up sort of further closer to the poles, and if you look at the equator is generally sort of running through here, then you see that countries close to the equator or around the equator don't seem to be so badly affected so far. So it is possible that India might have a lighter version of the virus. Fingers crossed. I think the lockdown has helped in creating a much more manageable situation for us. But I do have to confess upfront that, I, along with many other people who are talking about the virus every day, we are not experts in this. And we'll have to figure out how the rest of the journey unwinds. So pretty much for the rest of the presentation today, I'm not really going to be talking much about the virus itself, but more about how we as individuals will be able to deal with it and deal with its consequences purely from a financial perspective. Most of our investments are through financial markets, whether it be debt investments or equity investments. And generally speaking, financial markets hate uncertainty. And uncertainty pretty much describes where we find ourselves right now. The things that we don't know at this point are quite significant and will have a significant bearing in terms of how all this unfolds. When will a vaccine be found? How much longer before the cases peak, before we start to say we are behind the worst and from now on things will only get better? And once we've done that, how long will it be before we get back to life as usual and business as usual? So these are very important questions, and unfortunately the answer to none of those questions is really known today. If you look at the vaccines, there are about 8 contenders, interestingly 4 of them from China, all of whom are building vaccines that show promise. but none of them are proven yet and available commercially. These vaccines are now in various stages of testing and trials. As far as positive indications go, though, other countries, like I said, China, for instance, has put the virus behind them and moved on. They are opening factories. Life is getting back to normal. Some of the vaccines, like I mentioned, are starting to show promise. And we seem to be slightly better off than many other countries around the world, possibly because of the warm weather, possibly because as a population, we've had either inoculations done when we were growing up, or because we've had some level of exposure to dengue and other illnesses like that. So our natural immunity may be higher. And finally, the government got off to a probably the strongest starting point compared to any other country around the world in terms of the severity of the lockdown. Of course, now the lockdown perhaps was easier than the opening up post the lockdown, which is really what we will encounter going forward. But there are some comparables, and I want to talk to you about this from a financial markets perspective. So if you look at previous outbreaks that we've had, and I want to caution all of you by starting out by saying that we have not experienced in our lifetime anything as severe as the coronavirus. So we've had SARS and bird flu and Ebola and Zika. It is quite possible that as an order of magnitude, the coronavirus is substantially higher in terms of the scale, scope, and impact compared to many of the other ones that you're looking at here. But there are perhaps some parallels that are worth drawing, which is that how does the financial market move when something like this happens? In particular, in all of these cases, we've looked at the Sensex, and in all of these cases, the markets start to correct quite sharply as soon as there is a fear that there may be a disruption to life and business. And it falls quite quickly and then reaches the bottom and then starts to climb off from the bottom. Now, the markets don't start falling as soon as the virus or epidemic has reached full proportion. It starts falling as soon as there is a concern or threat that, something like that might happen. We all, I guess, want to know when the bottom may be. And the bottom, I think, in every case in the past has been one where the markets have bottomed out as soon as the fear fades, control is tangible, and hope starts to emerge. So broadly speaking, that is the time where the bottom will be found. Whether it is a question of viruses, whether it is vaccines, whether it is a question of cases plateauing out, and now we are on the path of recovery. And the reason why that happens, the reason why we don't wait until the last person is cured, is because the market is full of opportunists. So everyone is out there looking to make money, and everyone is out there looking to make more money than their neighbor, the other investor. So in such an environment, which is a very competitive, very intense place, people don't wait until the good news actually pans out or the bad news actually pans out. As soon as there is a thought that something like this will happen in the future, people react today. In the same way, we will not wait for everybody to get cured before the market starts to come off its bottom. We will wait only until we feel like, the recovery is visible, and then immediately the markets will start climbing off from there. This is all just to explain how financial markets think and work. We still don't know, if you like, whether we are here or here or here in terms of where we are relative to the bottom. We had a very sharp correction where we went from, say, 42,000 in the Sensex all the way to 26,000. And since then, we've come off that and we've been hovering anywhere from 30,000 to 34,000. I suspect that until there is greater clarity about the path forward, whether it is vaccines or peaking of the virus or anything like that, we will hover around these levels and then gradually sort of recover from there and head on northwards. There was a hope in the beginning that the correction was very sharp, so the recovery will also be very sharp. It doesn't look like that's going to pan out. It looks like the recovery will be more U-shaped because the impact on business in the short term is likely to be felt. People will have to overcome their fear about contracting the virus and normalizing their behavior, normalizing their activities. And then, we are likely to start to see business recovery and markets recovery as well. Again, in all of these things, history is a great teacher. It's useful to see how the markets have dealt with previous episodes that were disruptive in nature. So if you look at this graph here, and apologies that it's so busy as it is, there's quite a lot of information here across all the way from 2073 until now. And across this entire period, there have been several things that have caused the markets to be meaningfully disrupted. Perhaps the most significant of them all from our recent memory has been the global financial crisis. And it is often being compared to what we are going through right now. And broadly speaking, if you look at episodes like this, what this graph shows is how significant was the correction from the top to the bottom, and how long did it take for us to recover. And if you look at the global financial crisis, that was the biggest one in our living memory, because the correction was almost 60%, and it took nearly 3 years for us to come off from there and get back to where we were before. So it was a very meaningful disruption, and it was very meaningful because the disruption was not an episodic one like SARS or MERS, which disrupts while it is there, and after that it's completely gone and there is no lasting effect. With the global financial crisis, you had regulators stepping in, you had the way companies behave changed, the way people interacted with financial markets change, and it was truly a global phenomenon in that it started in the US, but then institutions collapsed all across the world. So from that perspective, from a financial markets perspective, that was the most disruptive thing. If you were to look at 3 different types of things that can disrupt the markets, and this was a study done principally around the US over a long period of time, Goldman Sachs has classified disruptions in 3 ways. One is structural disruptions, one is cyclical disruptions, and the third is event-driven disruptions. So what we have now with the virus is an event-driven disruption. So basically, it is something that comes, creates a disruption, but once we are behind it, hopefully there won't be lasting effects. And that has been true to describe all the previous virus episodes that I've shown you, whether it be SARS or MERS. When it was there, it was pretty troublesome, but once it is dealt with and once it's behind us, then life goes on as usual, businesses go on as usual. And if you were to classify the coronavirus as an event-driven virus, which is probably the most apt description, the characteristics of an event-driven disruption is that the declines tend to be less sharp, the duration for which it lasts tends to be quite low, and then the time it takes to recover from that compared to a structural disruption like the global financial crisis is also quite low. So it is quite troublesome for us to go through this phase, but I think the hope that we have is that once we put it behind us, then us getting back to life as usual, business as usual will not take that long compared to other disruptions that we've encountered in the past. Now, if you look at this slide here, I think the important thing to realize is that not all countries will go through this episode in an identical fashion. Some countries will be extremely badly hit, some countries will be less badly hit, and some countries will actually potentially even benefit from such a thing. Now, what is the India story in this case? I think if you were to look at the India story, one of the factors is that because of the significant slowdown in business activity as a result of the virus episode, the consumption of crude oil has fallen, and as a result, the crude oil prices have fallen sharply. Now, this is a very significant thing from India's perspective because India imports 87% of its crude oil consumption. It is the 4th largest importer of crude oil in the world. And when we don't have to import as much crude oil, or the crude oil we are able to import costs us a lot less, as it is true now, we tend to save quite a lot of money. So that is one benefit that we get as a country because of the fall in crude oil prices. Our balance of payments improves substantially. And, so that is one factor why India may actually come out looking not too bad as a result of this episode. The second one is that global supply chains hitherto have been very tightly integrated with China. And now suddenly countries all across the world who are manufacturing countries are starting to look at their supply chains and inspect it carefully to figure out how they can de-risk themselves from this extent of getting hardwired to China. There's this case of a German auto manufacturer who had to pretty much stop their supply chains, who had to pretty much stop their assembly line because they were importing from China a pigment which was used in the painting of their cars, really to give it that final glossy shine. And this pigment was being manufactured in Wuhan. And because of the disruptions to the global supply chain, what happened was that this was no longer available, and they couldn't afford to send their premier luxury cars out onto the streets looking half done. So it's things like this that really cause a disruption to company supply chains, and now they start looking at alternatives. How well we are able to benefit from this depends a little bit on how well we play our cards, but it is possible that as companies exit partially or wholly from China as a manufacturing destination, some of that flows may come to India, and that will benefit us as well. So that was by way of a little bit of context about the virus. Now let's look at what does this translate into for us, the individual or family that is an investor. Broadly speaking, we've been talking extensively to our customers as we go through this phase, and you can classify them into these three categories. You have people who, as a result of what is happening, are quite distressed. You have the other category, which is calm, who are able to deal with whatever is happening with a sense of, this too shall pass, if you like. And then you have the third category, which is those who are opportunistic, who really see that, behind every dark cloud, there's a silver lining. And we are experiencing kind of all three of them. So I just wanted to spend a little bit of time describing each one, so you may be able to associate yourself, if you like, with one or more of these categories. And I'll also spend a little bit of time talking to you about, how you may be able to deal with the situation depending on which camp you're in. The worst hit are people who are in a situation not through their frame of mind, but mainly because of where they find themselves in their journey through life. If you think of a person or a family who has major cash outflows planned, such as maybe sending a child to college or already having made a down payment on a house or something like that, they've made a certain commitment, they have significant meaningful cash flows at this stage in their life, and suddenly their portfolio has dropped by 30 or 20% because of the situation we find ourselves in. So with the portfolio size having shrunk, the ability to fund the outflow suddenly becomes in doubt. And that is one category of people who find themselves in a bit of financial distress right now. The second category of people are those for whom inflows themselves have changed. So either due to the company saying we should all take a pay cut to help us go through this, or certain people being made redundant, or if you're a freelancer, then suddenly finding that there isn't really that much of work available right now. And due to all of these, or one of these reasons, you find that your steady cash inflows that you're used to suddenly has become quite disrupted. We would advise that if you find yourself in any of these situations, to take pause really, because often the gut reaction to do something may not be the best thing to do. We would recommend that what you should do right now is to take stock, really identify your asset portfolio and identify the best sources of liquidity. So if you wanted that money, what is the best place from which you can get it? Is it from within your portfolio? Are there other options that you can consider? And that's what I meant by saying consider both assets and liabilities. And if you find that taking on loans is either not possible or not readily available right now, and you really need to look at your assets and find out how you can start to draw down on them, then we suggest that the best way to do that would be evaluate all of your assets on the basis of the risk that they are exposed to, the return that they can potentially deliver, what kind of liquidity they have, and what is the tax impact of potentially taking your money out. And the combination of all of these four factors, each of which is very important, will help you prioritize and decide where is the best place to start taking your money out from. And of course, you can work with a financial advisor who can handhold you through this journey. But that would probably be a good way to go about it. The best approach to take is to go through this journey having a slightly more philosophical approach to things, saying that, this shall pass, this is the temporary disruption, and, once this we recover, then life will go on as usual. Market volatility, as I've said here, is a given in the short term. And one thing that we find is very useful to bring a sense of calmness in the way you look at this is to keep in mind that most of us are traveling a journey that is not measured in days and months or years, but in decades. For most of us, we are looking at, being anywhere from 30 or 40 or 50 or 60 years old and expecting to live 80 or 90 or 100 years. And, our money needs to be our journey partner throughout that entire phase. So it's really the number of decades that you have to plan for that is relevant. What happens in a month or two, what happens in a few quarters isn't really that significant when your journey is that long. So having that context or framework within which to look at things will help you in knowing that, while this may seem very disruptive right now, it will also pass. And if you were 80 years old and looking back at your journey, you'll remember this, but you won't remember it with a great deal of horror. It'll be an interesting story to share with your grandchildren. So, to have that belief, to have that idea that this is actually a long journey and little speed bump along the way would help in getting you to that state of calmness that we recommend that you approach this situation with. And then we have the third category of people, which are really opportunists. And there are two camps here. There's one camp which is markets have fallen, the markets have corrected. This is a great time to actually jump in and buy. Why don't we go ahead and accumulate some assets because the prices are very cheap? It's a discount sale where the discount is on the Sensex and it's a 30% discount. So why wouldn't you buy? So that's one school of thought where people are saying things are very attractive. Why don't I jump in and invest in a serious way? The second school of thought is that, this is just the beginning. We are not even at the bottom. We are not even near the bottom. There seems to be substantial downside from here because, the cases are still peaking. People are still falling sick. So there's still a long way to go down from here. So why don't I exit now? And then I know when the bottom will be found. And as soon as the bottom is found, I'll jump back completely and, take advantage of that move. In both of these cases, I would suggest that there is an element of market timing that you're trying to do. And quite frankly, it has been well established around the world that market timing is something that eludes almost everybody. There is nobody who has been able to do it consistently enough that we can say that this is not luck, it is skill. And they are able to consistently do that. So a little later in the document, I'll be talking to you about asset allocation. And that's really what I would advice to the opportunists that are out there who are looking to jump in with a significant chunk of money because the prices are cheap, or those who want to exit now and jump back in later after the market bottoms. So if you're opportunists, it's an interesting place to be, but it's important that you approach the opportunity because there definitely is an opportunity, but it's important you approach that opportunity with a sense of clarity of purpose and a goal that you can work with. Which brings us to asset allocation, which is probably the most important thing that we provide to our customers. We help them manage their portfolio and do asset allocation so that they are able to navigate periods like this very effectively. So I just want to share a couple of slides again by way of context. And as you can probably guess by now, I love to talk about things spanning multiple decades because that is the only thing that really gives us perspective when we are looking at dealing with disruptions like we have now. how have we dealt with disruptions like this in the past over the many decades that we've seen, and therefore what perspective does it give us as we look to manage our wealth over decades in the future. So here are 4 assets that we've mapped all the way from 1981 till now, and let me just quickly explain to you what this means. So what I've done here is to say, if you had $1 lakh to invest in gold or silver or fixed deposits or PPF, and you had done that in 1981, what would that be worth now, right? So if you were to look at gold, then gold, which if you had invested $1 lakh there, would be worth about maybe 26.5 lakhs. Silver, perhaps not as much, more like 15 lakhs. 1 lakh would be worth 15 lakhs now. If you were to look at FD, if you were to look at FDs, fixed deposits, then using a baseline fixed deposit over this entire period, fixed deposits you would have done reasonably well. Your fixed deposits perhaps would have been worth about 27.5 lakhs. And finally, the PPF, which is a very tax efficient way of saving money, that would be worth about 36 or 37 lakhs. And there's a pink line here, which is inflation. The way to think about the pink line is that if you had something that you could buy for $1 lakh in 1981, how much would that cost today, right? And that translates into 1 lakh then would be worth about 13.5 lakhs today. So one fundamental principle that we have when we look at financial planning is that no matter what you do, you need to generate real returns. And by that, what I mean is that you need to do better than inflation. The good news looking at this picture is that all of them have done better than inflation to various extents. Gold, silver, fixed deposits, PPF. The notable absentee in this picture, of course, is the equity markets. The reason I couldn't put them onto the same slide as these other assets is because the axis needed to be different. So I'm going from 0 to 40 lakhs on this picture. If I had to include equities, then I would have to change that axis from 0 to 350 lakhs. Because that is the extent to which investment in the Sensex, suppose you had invested 1 lakh in the Sensex, then that 1 lakh in the Sensex now today in 2020, even after the sharp correction that we've seen, is worth about 170 lakhs. The rest of them kind of cluster at below 50 lakhs. You know, we looked at the PPF and that was about 40 lakhs. So the wealth creation potential that equities have is something that is really surprising. And as you can see from this slide, the Sensex, which if you had invested $1 lakh in 1981, would be worth now about 170 lakhs. Now, I've got another one here, which is called Sensex TR, which is the total return. And by total return, what do I mean? The Sensex doesn't capture things like dividends, whereas the total return includes that. So once you include dividends and other payouts that you get as a result of being a stock investor, then the picture looks even better for equity investing. And you know, your 1 lakh in 1981 is probably worth about 245 to 250 lakhs today. Again, the comparable number for gold, silver, FDs, PPF, all of them were somewhere in the range of 25 to 35 or 40 lakhs. So over a long period of time, over decades, equities is a very powerful wealth creator. So why does anybody invest in anything else, you could ask, right? So I think the picture itself gives you part of that answer, which is that if you were to look at all of these lines are all reasonably steady, reasonably even. Gold, of course, and silver, of course, have their ups and downs, but your normal debt instruments, whether it be FDs or PPF, are slow, steady, gradual wealth creators. Whereas if you look at this picture, it is quite a steep line, but it has got lots of ups and downs. And therefore, investing in equities requires patience, requires a mental aptitude for this kind of volatility. But the price is worth it, right? The price is worth it in that if you were to invest in equities consistently over long periods of time and have the stomach for the ups and downs, then there's no other wealth creator that is comparable to equities over this time horizon. Now, if we agree that, equities are strong wealth creators, but can really give you stomach churning movements from time to time, then what is a sensible way to invest in equities? And that's where asset allocation gives you such great clarity in knowing what to do when you're investing in equities. If all of us are looking to invest so that we can maximize the wealth that we create, then really what we are trying to do is follow a very basic principle, which is that consistently in everything I do, I want to buy low and I want to sell high, right? The problem when it comes to equities, of course, is knowing when it is low and when it is high. And that is really where asset allocation comes in and is so powerful, because it gives you a framework by which you can consistently do this. So I'm just going to use a simple example to explain how this may work. And it does work because this is what we as financial planners do for our customers, and we've done this over the past 15 years. There is no doubt in our mind that asset allocation is a very powerful framework to use when you're trying to manage money, either for yourself or for a client. So let's consider this example. Let's say you have some money and you've decided that you will maintain a portfolio in which half of your money is invested in growth or shares, let's say, and the other half is in safety or fixed deposits, let's say. This is what you're setting out to do, is that you're going to consistently maintain an asset allocation, which is 50% equity and 50% debt, right? A few more rules here. The first rule is that we will maintain a 50-50 allocation. The second rule is that in case we deviate from our 50-50, we will come back to 50-50 every quarter, right? Those are the two rules. So let's take an example where we apply these rules. Let's say that we were starting to do this in July. We had 20 lakhs to invest, and we decided that we would put 10 lakhs in equities and put the other 10 lakhs in debt. So we've done that. We've selected the right instruments. We've selected the right deposits. We've selected the right funds, and we've done this 10 lakhs and 10 lakhs. Now, between July and October, we go through a bull market. And what happens in a bull market? Equity prices go up very sharply. And again, I'm using this to illustrate my point. 50% increase or 55% increase in the portfolio on equities. Your equities are now worth 15.5 lakhs. Debt continues to keep growing slowly and steadily. So let's say 10 lakhs has now become 10.5 lakhs. Our overall objective here is a 50-50 portfolio where we want 50% in equity, 50% in debt. So what we would do in this case is to sell equities worth 2.5 lakhs and use that money to buy fixed deposits worth 2.5 lakhs. As a result of which we've come back to a 50-50 balance, right? Our overall objective is to have a portfolio that is equally balanced between equity and debt. When we got disrupted from that, we took an action that will help us come back to the same asset allocation of 50-50. Now, let's assume that so once we've done the 50-50, we went into a bear market. And what happens typically in a bear market is that equity is correct. So let's say 13 lakhs became 10.5 lakhs. Meanwhile, debt will continue to grow slowly, steadily. So 13, let's say, has become 13.5. So at this point, you have a portfolio that is worth 24 lakhs. You want to come back to 50-50. So what you would do now is to sell 1.5 lakhs worth of debt and use that to buy equities worth 1.5 lakhs. So you're back in balance at 12 lakhs each. Now, as a mechanical framework, this seems fairly straightforward, right? Every quarter, you look at your portfolio, decide what you have more of, what you have less of, and then you correct the portfolio to come back to balance, right? Mechanically, this is quite straightforward. We can all do this, I hope, right? So as you're looking at the portfolio, you decide what you have more of, what you have less of, and you take the necessary corrective action. But what is interesting is the result of what we have done. When we started out, we said we were not very clear about how to buy low, sell high. What this helps us to do is, when the markets went higher, we sold, and when the markets corrected, we bought, right? So what changed here is that there are two things that we changed. First is that we had a clear goal. We said our portfolio has to be 50-50, and in case it goes away from 50-50, we will do whatever is needed to come back to that 50-50. And the second thing that we said is we bring a discipline to how we invest. And our discipline here is that we will not keep on taking decisions all through the year. We won't be, reacting to every single thing that happens in the market. We are only going to take corrective actions once a quarter. So two things, the goal and the discipline together helped us to achieve something that otherwise most of us would consider to be quite difficult to do, although highly desirable. And this is really the power of asset allocation. It helps you to create the right investment behavior of buy low, sell high by consistently following this objective of having a goal and having a certain discipline to follow that. So let's now move to the role that people like us play, as financial advisors. What is it that we principally bring to the table? This is a sort of back of the envelope on a napkin picture that a very famous investor and psychologist has drawn up. His name is Carl Richards. What he's done here is he said that if you look at any investment vehicle, he's always found that the return of that investment has always been met only partially by the return that the investor got. So suppose there is a equity mutual fund, which on its brochureware says that it has consistently over the past 10 years or 15 years delivered an annualized return of, let us say, 18% or 16%. If you were to look at the folios of people who invested in that and look at the returns that individual investors were able to receive, then very few individual investors actually received the average investment of that instrument. And that came about because of what he called the behavioral gap. The behavior gap is what caused investors not to really be able to realize the full benefit of the investment's return. Now, what causes this behavior gap? In a nutshell, I would say that there are two characteristic traits that all people have, all investors have, which is greed and fear. And these two things contribute to the vast bulk of behavior gap. So let's take a look at an analysis that was done in terms of how people behave depending on what the market does. And if everybody wants to buy low and sell high, what actually has happened is the following. And this was a study that is slightly old. It was done between 2003 and 2012, during which time we had the opportunity to look at very attractively priced markets, very overbought markets. So one good indicator, one useful way to see how attractively priced the market is to look at the average 1 year forward PE and the PE ratio, which is, in a nutshell, it tells you, how cheap or expensive a market is. And if you were to look at, this journey, it went from 10 all the way through to 20 just before the global financial crisis, and then corrected and came back down to 14.5. So at 20, it was really expensive. At 10, it was really cheap. Let's see what happened in terms of the investments. So when the markets were this cheap, a total of 118 crores got invested into the markets. When the markets were really expensive, 52,000 crores got invested here. And again, when the market became reasonably cheap, only 504 got invested. And it seems puzzling when you think about it, but if you understand human behavior and sentiment, it's quite easy to see why this happened. When the markets were at 10.34, we were in the grip of great fear. The markets were very low and people were perhaps thinking, well, it's already low, God knows how much further it has to go. So in fear, people don't really invest. Similarly, when you had the market at 20.56, then the markets were really expensive, but a lot of people had made a lot of money coming to that point. And that was when the markets were in the grip of greed. So everybody's made money. I want to join the ride. So a lot of people started investing. So a lot of money came into the market, 52,000 crore in financial year 2008, leading up to the financial crisis, when the average PE was 20.56. So this is the behavior gap that Carl Richards was talking about when he said an instrument may deliver a certain return, but the investor doesn't realize it because we want to buy low, sell high, but what actually ends up happening is that you end up buying high and selling low. So how do we address this? You address this using asset allocation, and that is where we tend to have a role to play. There are three things that over time, I've realized I've been able to bring as value added to my customer conversations or customer journeys. And those are these three. So one is to help you understand where exactly you are, kind of take stock, articulate very clearly what your dreams and goals are in your life, have a clear documentation and understanding of where you are right now, and then have the ability to come up with sensible plans that you are able to achieve through financial planning. If you want to retire next year, is it possible? It may well be possible, but if it's not, then you can have a conversation around that and say, okay, may not next year, but maybe 3 years from now, right? If you would like to take an international holiday every 6 months and spend maybe about 10 lakhs on it, is it possible? Again, having that conversation with your financial planner will really clarify a lot of these things for you. So the first thing is understanding where you are. The second is then taking what could be words spoken and translating that into actual investment decisions on the ground. So your advisor will help you execute the plan that you've come up with, implements the agreed decisions, keeps track of whether things are going as per plan, and in case corrective actions are required, then putting in place those corrective actions so you can take the benefit of that. In case things go off plan because something has changed in your life, something has changed in the markets, or a particular instrument underperforms, then you can take remedial action to bring your portfolio back on track. And the third is your advisor helps you protect you from yourself. Like I said, the greed and fear are very powerful emotions, and I can attest to that over the past 15 years of working with customers, that when you're in the seized, when either greed or fear has really seized you, it has almost a paralyzing effect on you. So you really want to buy when you think the market opportunity is attractive, and if somebody is holding you back, you tend to resist that. Similarly, you want to rush to safety, and you really need to be counseled to put things in perspective and do the right thing for your portfolio in the long term and not take hasty decisions. So if you are considering working with a financial advisor and trying to figure out, well, what am I going to get from these? Working with a good financial advisor, I would suggest that these are the three things that you can expect to get. One is a good understanding of where you are. Second, once you have a plan in place to actually execute to that plan. And third, it's like going to a gym. You get a good trainer who helps you, pushes you when you need some pushing, calms you down when you need some calming down, helps you control your greed and fear. So this is really what an advisor has to offer you. I have one last section about PeakAlpha. I'll close with this and then open up for questions. PeakAlpha was founded in 2005 by Priya, who is both my wife and a director in the company. We started the company in 2005. I have an MBA in finance from Wharton, and since then I'd spent a number of years as management consultant with Accenture and emphasis in India before starting PeakAlpha. Similarly, Priya has studied in the US and then subsequently had a career in investment law before helping with PeakAlpha, getting it off the ground in 2005. Now, who do we work with? We principally focus on people who are salaried, and we don't particularly focus on the ultra high net worths. We believe that we want to play to our strength, which is financial planning. And financial planning really helps people answer the question, will I have too much money at the end of my life, or will I have too much life at the end of my money? So for people for whom this question is relevant, that is the customer base that we typically tend to work with. I have a picture of my team that I'll show you shortly, but we all care deeply about helping our customers navigate through life and get the full value of what money can do for them in their journey through life, and that's what excites us. Products themselves are a means to an end. I think what we really care about the most is make sure that each and every customer of ours is happy and smiling when they are 80 years old, and that is our primary focus. And when we try to achieve that, we look at assembling best of breed products and bring them to the table so that it can be part of our customers' portfolio. God has been very kind to us over the past 15 years. I think we've been acknowledged quite often as India's best financial advisor by UTI, CNBC, TV18, and Outlook Money. So our customers have stood us in good stead through this journey, and we are very grateful and humble about that. I'll just leave this up there for you to take a quick look at. These are some kind words that our customers had shared about us. In terms of our size and scale, we are about 35 people, based principally in Bangalore. And having said that, our customers are all around the world, really. And with Skype and Zoom and things like that, that gets easier and easier. So this was the founding team in 2005, and since then we've grown, and this was taken when we won our last award, hence the excitement in the picture. And there are 4 pillars to PeakAlpha. One I've already talked about, which is financial planning. The second one is something that we set out right at the outset to do, which is to treat our customers' money as we would if it were our own. And that is a principle that has stood us in good stead right through. We tend to use quite a lot of technology because of my experience in the intersection of financial services and technology as a management consultant, both in terms of how we engage with our customers as well as in terms of how we run our back office operations. And finally, through sessions like we are doing today, we do spend a lot of our time doing investor education, and it has been very satisfying as a thing to do for us, and it's something that we are committed to doing. So thank you all so much for taking the time to join us today, and I hope it was useful. Friday evening, 4:30 to 5:30 is an interesting slot to pick to think about money and financial planning and financial advice and all of that. I'm glad you all took out the time to engage with us. If you have any further questions, please do drop us a line and we'd be very happy to engage with you as well. Take care and have a good weekend, and stay home and stay safe.